This week, Amazon is reporting their earnings on April 27th. So this is a big week. It's a big week for the stock market. Last year, the stock market during this week actually dropped a ton. So I don't know what to expect since we're in a bullish market. But I'm really expecting Amazon to pull through. We're going to start a year here with extreme growth from Amazon. I mean, they've already grew insanely just in the past year. I mean, in January of 2015, their share price was only $300, and today it's almost $900. So their share price has tripled in 2 years, and that's contributed to just how they're growing and how they're doing that. So I'm going to go over a few things in this video. So, I've been reading for hours and hours about Amazon. I've been looking at their 10K report for 2016, their quarter 4 report for 2016. I've also looked at the overall market that they are targeting, which is both the e-commerce market and potentially the retail market. And looking at these numbers, I have found some huge numbers that will really prove themselves in the future and also back up Amazon's growth. So I'm going to talk about, how Amazon's growth affects both the company and how that growth will be in the future and what it will look like. Because I'm also looking at the position that Amazon will be at in another decade and a position in the market of where they stand. When I first looked at Amazon's numbers, just straight off Yahoo's statistics page, I was discouraged because of the huge share price and the huge PE ratio. And so those two things kind of drew me away. But when I read through their 10K report and their quarter reports, I came to a better understanding of why the share price is valued so high and what this entails for the future. Their last stock split was in 1999, and it was for 2-for-1. So maybe we'll see one of those, but I don't talk about that in the video. Moving on, I'm looking at Amazon's 2016 10K report for this video. I'm also looking at the quarter 4 2016 report. Some of the data I'm taking for e-commerce market size and retail market size is from census.gov, and this is for the United States e-commerce retail market. And Slice Intelligence has provided some good information on the e-commerce size for North America, which is what Amazon divides their balance sheets by: regional, North America, international. So that was good information to look at. I also found total retail worldwide sales annually, and also United States annual sales through the International Trade Administration. So this data I'm finding is from the government. It's provided by the United States government. And I'm going to be analyzing Amazon's position in these huge markets and maybe what competition they have or what Amazon's current growth quantitative values mean. So first thing are just the key statistics on Amazon. They have a beta of 1.4. So this means that they'll underperform the market 40% more than how the market is underperforming, and they'll also outperform the market by 40% more than a market that is outperforming. So in a bullish market, owning Amazon is going to give you 40% more, and in a bearish market is going to give you 40% less. So it does depend on the market. We see earnings per share at 4.9 for the year, and we can compare this with 2017 estimate of 7. So this is a 43% increase for their earnings, which is great to see. But their quarter 1 estimate is about the same as their previous quarter 1 estimate, and also their quarter 2 estimate is about the same as the previous quarter 2. So it looks like there are higher estimates for quarter 3 and quarter 4 in 2017. That might be the best time to get in and buy the share. Because we also see quarter 4 as Christmas, which is the most profitable quarter, and they mentioned that in their report. Forward price earnings at 72. So this would mean that it would take me 72 years to recoup my investment. But we also have to consider that Amazon is growing, and their forward PE, which is the yearly estimate, is down from 183, which is their trailing estimate. So it shows that their PE is going down, and it's good to measure the price to earnings ratio, because if you own one share and earnings was distributed on a per share basis, this is the ratio that would show you how much years it would take for you to recoup your investment. It shows you the cost to buy one share, and then if each share you owned earned what the trailing earnings per share is at 4.91, it would show you how long it would take to recoup your investment based off of the earnings per share. Of course, Amazon retains their earnings, so you don't get any of this earnings money back, but it's showing you the value of a single share and how much that share would earn you if it did work like that. So with a PE of 72, it would take you 72 years to recoup your entire investment at the current price to earnings ratio, which will definitely go down in at least 1 or 2 additional years. One of the greatest values for them is return on equity. It's at 14%. So I would get a 14% return on my investment if all the earnings were split up based on share. Now, I would take this anytime, and looking at high ROE companies is really great, and it shows that a company is steady. So this is taking into account the total stockholders' equity and having that net income divided by it. But of course, Amazon retains the earnings, so the individual investor does not receive anything, but it's showing you the value. And also it's showing you that if they stop retaining earnings, this is the estimated value of the interest that you would receive if you invested in the company, which is 14%. Onto one of their best numbers is quarterly revenue growth, and it's at 22%. And this includes foreign exchange currency rate losses. So they lost a few $1 million from foreign exchange currency just fluctuating quickly. But if we compare this previous year's corresponding quarter, so if we compare quarter 4 to the previous quarter 4 of 2015, showing you that the revenue growth is 22%. This is a growth number to show how each individual quarter grows in revenue, and this boosts the entire annual revenue, and it also supports it because each quarter has different revenue numbers just because of seasonality in retail. This is a good measure to see how revenue is growing per quarter, and it's showing, not just quarter 4 is growing in revenue, it's showing that all quarters are growing in revenue. Onto their debt is only $20 billion. And $8 billion is in low coupon notes worth about $1 billion each. And these are pretty long term. And they're low interest, so they're around 3% averaging. So I'm not worried about that. They have $12 billion in other liabilities. But these debt numbers are super low compared to their market cap. Right now, $20 billion debt is only 5% of their market cap. On to Amazon's individual data from the reports I read, their 10K and their quarter 4 2016 report. So on the quarter 4 report, it looks like net sales increased 27%. And this is from 2015 to 2016. So putting this in perspective, is if Amazon's net sales were $100 billion, which is a little under what they are, and they had 27% net sales growth, they would have $127 billion net sales in 1 year. And $27 billion in revenue is worth the majority of S&P companies. And so this number is also assisted just by the quarterly revenue growth. It's a kind of averaging assist from each quarter. So each quarter is supporting it, not just the fourth quarter, not just the first quarter. Every quarter is assisting how the revenue grows. Net income has also quadrupled, which is an increase of 400% from around $600 million to $2.4 billion. And this has been a part because of an increase in their operating income, which doubled, and it went from $2.2 billion to $4.2 billion. And they like to measure on operating income because they have a large variety of services and different sales, and so this can make it difficult to see how net income shows how much they earn. Okay, on to the next point. In quarter 1 2017, estimated revenue has a low estimate of $33.25 billion. And it has a range between 14% or 23% compared to the previous quarter 1 2016. And this is a pretty low guidance, and it's like an average growth of around 20%. This low guidance is because of foreign exchange rate losses to them. Even though it's a lower guidance than the quarterly revenue growth of 22%, it's still a high number. It's still at averaging 18 or 19% for quarter revenue growth. That's increasing operating income, which is increasing net income. If they choose to allocate net income so they can have higher earnings. Also, operating income is expected to be lower in quarter 1 2017, which is going to be between averaging $500 million compared to the 1.1 billion it was in quarter one 2016. So we're seeing some numbers being guided lower, and they have really substantial uncertainty that they can see in the quarter one estimates because of foreign exchange rates and the variety of the company sales that they receive. So this data, backs up where the revenue growth is supported, and is supported on a per quarter basis. So it is not dependent on Christmas or a season, which is really great to see. Okay, so on to my favorite part. So North American e-commerce market size is 666 billion annual sales, and this is for 2017. The United States contributes 75% to that number. And this is the market that Amazon is already highly penetrated in, as well as high margins in. So they only have 80 billion North American sales. Because of this, there's still a long way to go. And this is one of the things I want to get across, is that as Amazon grows, so is the market size. Now, the worldwide e-commerce market size had total retail sales at 1.3 trillion annually as of 2014. Right now, this is a huge market. It's about 10% the size of the retail market, which is at 14 trillion worldwide retail sales. For the United States, e-commerce annual sales have been growing at a rate of 15%. And at this rate, in 10 years, we will see an e-commerce retail market above $1 trillion in the United States alone. So with growth at this level for just the market, because Amazon is growing with the market, they have more sales as the market grows, and this will benefit their company and keep their company growing, even if they hit total infrastructure and they have access to every customer in the world. The market will still be growing, and so they will still be growing. As we can see now, retail sales have been just dropping worldwide, and companies like Macy's and JCPenney, they're closing stores. Retail sales are moving to e-commerce sales. If only 10% of total worldwide retail sales were converted to e-commerce sales, then the e-commerce market would double. And this is what makes Amazon so large, is because they are targeting a market size that is immense, and it's also a growing market. Worldwide retail sales have been at 14 trillion, and the United States contributed 5.5 trillion to that. So as we see the world kind of moving on to online sales, we're going to see that brick and mortar shops are going to be moving online. And as this happens, Amazon benefits from it because they have penetrated the market, they have a brand, and also they're one of the first companies to do it. And they're the largest doing it right now. So the e-commerce market size in only North America right now is larger than the entire advertising market, which is part of Google's target market. The advertising market is only around 500 billion. And so while Google is a massive company, they only could grow so much because the market is kind of a steady size, and it's a small size compared to retail. Amazon's target market is the entire retail as well as the e-commerce market. And right now it's measured by trillions. So just consider where companies are getting their revenue from and what markets those are. Amazon is growing because, one, they're a new company and they're still building and expanding as a company. They still have a long way to go internationally, and they have yet to see a profitable international business because they have a lot of infrastructure they need to build. And as they grow at this annual sales rate of 27%, these numbers will stay steady at 27%, just because the e-commerce market is growing with the company. So as they grow side by side, Amazon's ceiling for revenue is massive. So some of these things aren't quantifiable, as in you can't put them in numbers. And the large target market is what is going to be Amazon's success in the future. And looking at the entire economy, the entire market size, the future of the company is this macro view. And this is the macro view that many billionaire investors look at. And so while the future is, completely uncertain, and you don't know the future, you also can't necessarily be based off historical values. It has to be considered to make strong investments. So Warren Buffett is known for holding his shares forever. And this is because he chooses a company that fits into the macro future and is going to be successful in those macro markets of the future. It is a fact that markets grow by time. And so if we know that a market is going to be large in the future and already is massive, then we know any companies who target that market will be successful if they execute their company correctly. On to the next. Another non-quantifiable value is that Amazon is growing. And once we see the highest point of that growth, which could be any amount of years, from 1 year to a decade, we will see that dividends are definitely 100% foreseeable just because of the large revenue they have. Their dividend will be exceptionally expensive because it is a dividend of the average consumer spending on retail, which you yourself has contributed money to. So because Amazon targets the retail market, which we contribute to, Amazon will have a dividend depending on how much money is spent on this market. One of the things we also have to look at is competition. And I'm going to consider two companies as their competition right now. We have Walmart and Alibaba. First, let's get Walmart out of the way. So Walmart's current ratio is 0.8. This means that Walmart has 20% more liabilities than assets, and these are debt. So second, their quarterly revenue growth year to year is only 1%. And for these two reasons, I'm going to put them aside. Alibaba is the upcoming large online retail, and it's huge. It has a quarterly growth rate of 54%. They also have a market cap of a little more than half of Amazon at $284 billion. But, however, they only have $15 billion in sales compared to Amazon's almost $140 billion. Amazon has 10 times their sales almost. So this shows that they're still far behind Amazon. There's more information to look at when we were looking at competition, but right now market size is so large that competition is fairly sparse, I could say. To conclude, we see that Amazon's growth is substantial because it is a young company expanding worldwide into a market of huge scale. Their growth is backed up and supported by e-commerce annual sales, as well as how that e-commerce market grows. And we also see that the conversion of retail sales to online sales growth is a huge number, and that contributes to the revenue. One of the things we see is that people shop online because of convenience, and I consider Amazon pioneers of convenience. Also, Amazon has huge estimates for revenue, increasing $30 billion in 1 year. So this is very large growth, and it contributes to a higher chance of higher operating income, and also contributes to a higher chance of having dividends in the future. And these dividends in the future will be huge. So while Amazon is still a young company, they just don't have a reason right now to provide dividends, but there's no reasons they won't in the future. And another thing to conclude with is this large macro view of the markets, and Amazon's step ahead of everyone else puts Amazon very far in the future, and I think it could be the number one company by market cap within a decade because of the market size they have been targeting. So is it a buy for me? Right now, it's not. I'll give you a reason why. We're just in a bullish market, and so if there's a retracement, there'll be a better opportunity to buy. There could also be a better opportunity to buy after the first quarter and after the second quarter. And because quarter one and quarter two estimates are both about the same as the previous 2016 quarter one and quarter two estimates. And we're going to see the revenue growing in quarter three and quarter four of this year. And this is when the share price, I think, has a better opportunity to go up. And I can also determine when I want to buy and if the market is going to keep being bullish. So is it buy for me right now? No, but I'm going to be looking at it in the future. And I want to invest in it because of the future dividends they will definitely have, as well as the growth that they're going to be seeing in the future to come. That was the video on Amazon earnings for this week. If you liked the video, hit the like button and also subscribe because I post early in the morning when the market opens, and this is when my videos have the most value. I post videos about the stock market, earnings analysis on companies, as well as planning to do some financial education videos. This week I'm going to put out a video on my 3 stock picks, so make sure to look out for that.